channel, and today I want to check out this video from Sasha Yanshin. Sasha Yanshin is talking about big tech is faking revenue. I think this is an interesting video whereby we can learn quite a few concepts like revenue recognition. We can learn about how actually big tech handles, their massively generated revenue or fake revenue, and also just understand what's behind the companies that are changing the world as we know it. So, yeah, let's check it out. Please remember to subscribe and let's chat in the comment about whatever we come out with. All right, let's do it.
Will pay AMD about $100 billion for 5 million graphics cards. At the same time, AMD announced that they are giving $100 billion back to OpenAI in the form of stock. A few days before that, OpenAI also announced that they will be buying $200 billion worth of graphics cards from NVIDIA, and at the same time, NVIDIA is going to invest $100 billion back into OpenAI. The problem is NVIDIA doesn't have $100 billion to give to OpenAI. But that's where the third deal comes in, because OpenAI is going to give Oracle $300 billion to use their data centers. Oracle is going to take the $300 billion and walk it across to NVIDIA to buy approximately 3 shit tons of graphics cards to shove into their data centers, so that those data centers can actually be used by OpenAI. And then NVIDIA is going to take this money that they just received from Oracle and use that money to invest in OpenAI. Did you get all that? No? Well, don't worry, because in this video, I am going to
All right,
explain
so to start off, basically mentioning 3 companies involved, and basically just off the top of my head, this is simply transfer pricing. That's really what's going on, whereby you're basically creating a conglomerate of, we call it departments, but now instead of it being a departments under one entity, it's departments based on entities, right? Meaning an entity has a specific task, and that task is coincidentally needed by the next company. And in that way, they effectively recycling financing from one company. And so, in other words, the first company will be financed, raising whatever loans and capital that it gets, generates a product, and then guarantees a sale by the next entity, meaning that the next entity will be buying from the company that has risen as a loan, making it look good in terms of its investors or lenders, and it will be able to repay its financial obligation because it will be generating income from company number 2. And then company number 2 will use the products, having paid the money to the first company, use the products that subsequently will be used by the third company. And the third company obviously, or in most cases, will have like a unique way of converting whatever company 1 and 2 has produced to make sure that based on company 3, the actual money will be made that will benefit the whole system. So company 3 should be well established, very important, and has a very good way of converting this whole operation into cash. So that's sort of like the overview. Let's check what actually is happening.
Unrelated concept called round tripping. Round tripping is a common type of fraud where companies just pass each other the same money in a circle to mutually inflate their valuations by pretending that they are doing more business than they actually are. It's like if there were 3 people standing in the room, right? And each one of them had a business. And all of those businesses were brand new. They've never made any revenue. Then business A goes and gives business B $100 and says, "Thank you, it's a pleasure doing business with you." Then business B takes that same $100 and goes and pays it to business C for, I don't know, some services. And then business C takes that same $100, goes back to business A and pays that $100 back. So now each business has $100 worth of revenue.
Yeah.
OpenAI's current valuation is 50 times their annual revenue. So that would make each of these three companies that just passed around a $100 bill worth $5,000. And you can raise money at that $5,000 valuation and collect a whole load more than that $100 from investors. That means that when they go to investors to collect the latest funding round, their valuation will be $5,000. And they can then use all the money raised to pay themselves really fat salaries, have a pretty good time. Now, round
Are they
tripping
gonna do
is a
some business
practice that
before
is
they pay
generally
themselves?
considered illegal in the United States and many other countries around the world because it artificially manipulates the market. It artificially pumps the stock. It's a form of securities fraud. So clearly, just so there is no misunderstanding, I could not possibly insinuate or suggest that the tech bros at all of these companies would be doing something that is illegal to enrich themselves. That is,
So I'm gonna pause it there. What he's saying and what I said previously have similarities. It's the same concept viewed differently. And I'm raising that because, in his point of view, he's being cynical about it, meaning it's a type of fraud. So there's already a prejudgment. But what you guys need to understand when it comes to business, accounting, and so forth, um, it's how you paint the picture. Yes, I'm an accountant, so guilty as charged, spoken like a true accountant, but there are principles involved. You don't just do this to earn a fat check or salary. There's actually, you know, hard work and exhaustive work that needs to be done. This is not just a magic strategy that you just wake up and decide to do it. You actually have to do the work. And what is the work? The work is each company must actually represent something. There must be assets, there must be an actual operation being derived. Now, what happens is, or the scheme is that they use one company to raise funding. And therefore, when they raise the funding, they use three companies, I mean, two additional companies or one or two more companies to generate a business case that legitimizes the security within the first business. And therefore, from there onwards, if they achieve that, and it's important to say they have to achieve it because you don't just do it. Once you achieve it, then it becomes possible to transfer the value through the value chain of businesses that are connected. Now, in South Africa, this is what we call connected persons or connected businesses. And when this happens, it has to be declared because it can create anti-competition behavior. So in the US, pretty much similar type of regulation, but once again, I'm pointing this out because as accountants and tax practitioners, we are aware of regulations that try to prevent anti-competitive behavior, and this is one of them. From an economics point of view, this is simply called colluding, but by definition, it is not colluding because it's in-house, right? But because there's, you see, the reason why this is so difficult to explain, not as a concept, but in terms of its morality, is that if, let's take the concept of colluding. If you're colluding, you are doing something against somebody else or to somebody else's disadvantage. Now, the gray area is that these people are not doing it to somebody else's disadvantage per se, but they're doing it to benefit themselves or to enrich themselves, to quadruple slash massively expand their profitability and their ability to raise money. In other words, they're increasing their asset value, and that gives them access to further capital, increase their revenue in terms of what they put in the books, because the companies that they're colluding with can expand their revenue. So, that being said, it's a scheme, but if declared properly, the tax authorities can allow it, but it will be treated differently. That's what will happen. And so long as it has economic value, it will be allowed. But if it's fraud or anything illicit, it won't be allowed.
100% definitely not what's happening here. But while we are looking at these companies, I thought I would walk through exactly what has happened in the last few weeks and draw it on a handy whiteboard so that you can see for
Nice.
yourself how this AI bubble is in no way whatsoever a really obvious example of round tripping that is happening right in front of us in the open, because tech bros get to pick and choose which laws apply to them. Laws like securities fraud, copyright protection, those only apply to schmucks like you and me, not the cool kids wearing hoodies in Silicon Valley. So let's start at the beginning. This
All
story
right.
really starts when a bunch of investors, along with Microsoft, find $58 billion down the back of the
Because
sofa
of
and
the
give it to OpenAI in
highly
various funding rounds.
valued company
Immediately
invests in
after all of
OpenAI.
that happens, OpenAI takes those tens of billions of dollars and gives them back to Microsoft to use the Microsoft Azure data centers. Microsoft takes the $10 billions of dollars that they've just received from OpenAI after they gave it to OpenAI in the first place and goes and gives them to Nvidia to buy graphics cards to put in their Azure data centers so that OpenAI can then train their models using those graphics cards in the Microsoft data centers. But Microsoft are not the only ones buying graphics cards from Nvidia. Google, Meta, XAI, and Amazon are all standing in an orderly queue buying the same graphics cards that are now being sold for 4 to 6 times the price that they used to be sold at before ChatGPT arrived in November 2022. All of these guys, all of these companies also have their own AI work. None of it actually makes any money, but it sounds really cool. It's pretty futuristic, right? When you tell girls that you work in AI on a Saturday night out. Just kidding. Of course, if you are a tech bro working in AI, you don't have time to go out on a Saturday. You're too busy coding to conquer the world. Anyway, then along comes Anthropic, another AI startup, and they
Okay, before we move on, I don't like the idea of they don't really make money. These people are making money. The difference is they are under a development phase. So when you're under development phase, your main inflow, not income, your main inflow is investment, because you are in a space whereby you're attracting investors, and it's a developing space. You're attracting investors, which, as a business, that is your revenue. It's a capital of nature revenue, because the more funders you get, or the more investment you're getting, that's an income. However, it is capital, so it's not like an actual business income, but it's income because it allows you to invest in a business and chase, right? And this effectively creates the AI race. And if you are in the lead of the race, the capital inflows are going to flow to you, and that makes you highly investable. That makes you highly valuable. So that speaks to two things. Yes, you're valuable because you are leading the future. You are giving power. So it's more than just about money. It's actually, who rules the future, right? And then what could happen in the future is that when the company finally actualizes and becomes the company it showed potential to be, then they're going to sell out. And when you sell out, you are going to pay back whatever monies that were invested in the business to the shareholders, right? And the shareholders will turn a profit because their valuations, or the investment that they make in the company, will be at a higher um, share price, and therefore they would have made a profit. And in that instance, that profit will be capital of nature, meaning that you're making a profit based on selling an asset, and therefore capital gains tax will be charged. So that's where now the realization of the income slash profit will be done in a future date. So they are making money, but it's a different type of thinking. Now, when you want to think in normal business terms, in terms of business income, they are making money based on the orders that they are getting. Whether they're making a profit is a whole nother situation. And in most cases, these companies don't want to make a profit, because if they make a profit, then they have to pay taxes year on year. Versus if they sell shares in a future date, they only get to pay taxes on the future date. Versus on the business income, you're going to be paying taxes each and every year. So yeah, it's not just them deciding to do this. It's how business works, it's how accounting works, it's how commerce works, and they are playing towards what's available and what makes sense because the companies need money, and they are orchestrating these networks because they just work. I mean, if you think of Microsoft, Microsoft was a company that produced, Office in terms of Windows operating systems and so forth. That was the future when computers needed operating systems. Now, Nvidia produces GPUs, CPUs, computational assets that Microsoft needs to be sold out there because then people will use computers and whatnot that will be included with the Windows operating softwares and so forth. So there's a vested interest for Nvidia to spread its stock or its products out there that Microsoft has a high interest in. And then Microsoft invests into Open AI because Open AI is the future, right? And for AI to be operationally sound and become what it's meant to be, it needs NVIDIA to create more chips. And while all this is happening, NVIDIA's stock price is busy going higher and higher because higher demand, higher the price. And therefore, the order book of NVIDIA keeps going up. So for me, all I'm just saying, this is basic business, right? It's complicated because it's convoluted. Wow, com- wow, it's complex. So Anthropic, let's hear what they have to do in this picture.
Also collect a load of money from investors, and the biggest one for them is Amazon, who give them billions of dollars to Anthropic, and then Anthropic takes those billions of dollars and gives it right back to Amazon to use the Amazon Web Services to train their models, just like what Microsoft did. It's exactly the same, but just with a different company. XAI.
So just to explain that Anthropic and Amazon deal, it's almost like a barter, but in an investment arrangement. So Amazon, Jeff Bezos has lots of money or is highly financially capable, and therefore Anthropic, as a rising company, needs money. Amazon has money, Anthropic has the capabilities. So instead of getting repaid in money or getting its money paid back, Amazon can get an return in kind. When it comes to dividends slash, yeah, the only thing that he's not saying is it a repayment of the loan or a dividend. So that can depend. If it's a loan, it will be a repayment in whatever the value of the said product is, or if it's an investment, then it'll be a dividend in kind. So either way, or dividend in specie, that's the technical word, meaning a dividend that is not cash based, but it's in a different kind. So once again, this is just accounting terminologies used in a highly complex business world.
Is a bit of a weird one. They're building their own data centers, and XAI was originally founded by Elon Musk. And to
Yes.
finance XAI, Elon Musk sold a load of Tesla shares, which at the time didn't do wonders for Tesla stock. He used a chunk of that money from selling the Tesla shares to buy Twitter, and then a separate chunk to start his AI company. Of course, XAI should have never existed in the first place because Tesla is a publicly traded company that also operates in AI. In fact, according to Tesla, 100% of their valuation should be based on AI, not the cars that they're making. And there is a clear conflict of interest because Elon Musk is the executive director of both companies, the essential person in charge of both companies. And he has basically siphoned out money, talent, and IP to build a startup that directly competes with Tesla. Now, at the time when this happened, the official line that was parroted by all the fanboys, of course, was that this is completely not the case. XAI is all about large language models, and Tesla is all about full self-driving and robotics. And these are not the same thing at all. They attract completely different people, blah, blah, blah. So the work that Tesla does is apparently completely separate, in no way related, would not benefit from having this basically the same line of work using the same GPUs for the same sort of thing. it would not be beneficial to have that within Tesla, which is precisely why now that XAI has merged with Twitter and pretty much run out of money because they've been burning so much cash, they are trying to get Tesla shareholders to invest in XAI. It is Proposal 7 at the Tesla annual shareholder meeting regarding board authorization of an investment in XAI. And a direct investment in XAI would strengthen Tesla's access to cutting-edge AI technologies, talent, and intellectual property. You know, the things that Tesla would have access to anyway if Elon Musk did not siphon that entire business line out of Tesla, but the Tesla fan club on Twitter is wildly celebrating this opportunity, this proposal to hand over loads of money to XAI.
Interesting take. Yeah, I have to agree with them on the conflict of interest in terms of Elon Musk using his capabilities to visually create a competitor, of which the reason why I agree is because all the success of Tesla has breeded for Elon Musk to be able to own Twitter, and therefore, on a secondary level, him coming with this XAI is ultimately yeah, a morally questionable move, but it makes sense because it's a development. So I think the reason why it got passed is because it was not an intention. It was more of a development, and it just so happens that because now what happens is, guys, you need to understand when you're dealing with shareholders, their main interest, and even the regulators or the um, companies watching over the watchdogs, they check or they need proof that anybody acting on behalf of shareholders that they're doing everything to the interest of the shareholders. And that's why the notice that he showed there highlighted exactly that. Whatever Elon Musk is going to introduce, whether it's a direct competitor or whatever, it's going to be packaged as an advantage to the original company that the shareholders are invested in. So once again, a play of words for him to say siphoning money and all of that, blah blah blah. Or didn't use the word siphoning, but he's just basically saying he's saying that Elon Musk is using the same shareholders to invest in a supposed competitor. But as much as I agree with the moral conflict of Elon Musk within this whole operation, I have to say that it actually differs when you look at the sequence of events and the development of what's happening. AI at one point was, sort of like nothing and just um, you know, thing that people can just use and it doesn't mean anything. But then it started to rapidly develop when it started gaining operational notoriety and people started using it in a way that is very effective, and it started to affect a lot of businesses, and therefore now it's at the level that a lot of tech companies need to invest in it. And as a proper CEO who has the interest of shareholders at heart, he came up with an idea to deal with this. And also, yeah, let me finish that thought. He came up with an idea to deal with this potential threat. Now, to Elon Musk's defense, and I'm not a Elon Musk fanboy, but all I'm just saying is, to his defense, if the investors of Tesla are investing in XAI, that's two companies or another company that they're able to get an early investment opportunity. And when it comes to investments, as an investor, an early opportunity to a potentially multi-billion-dollar deal is an exceptional prospect. It's something that they will be excited to actually partake in because they will be early investors in a company that could 100x, 10x, whatever the amount may be. So, once again, this plays towards Elon Musk in terms of what he's doing, and whatever that could be cynically viewed will be brushed out and aside because everybody is focusing on the future potential, on the future of real money coming in. So, yeah, that's what I have to say about that.
Because they, I think, suffer from Stockholm syndrome. But I digress. A bit of a tangent. XAI also just collected some funding from, drumroll, Nvidia. And that lets XAI take the money that they just received from NVIDIA to buy more NVIDIA graphics cards for their Colossus 2 data
Somebody
center
has
that
to
they
make
are
the
building in
product.
Memphis.
That's
So the
what I
result of all
said.
this activity is that every company on this whiteboard has seen an absolute explosion in money moving in and out of their bank accounts and cash flow, because you see money moving between them in a sort of round trip kind of way. And the biggest benefactor of this has been NVIDIA, whose share price has gone up over 1,600% since ChatGPT arrived less than 3 years ago. So now that NVIDIA is rich, they are printing money, we have got this new wave of announcements coming. These ones are bigger. NVIDIA is going to invest $100 billion into OpenAI. They don't have even remotely close to $100 billion they could invest, but that does not matter because OpenAI is going to apparently take that $100 billion and use it to buy $200 billion worth of NVIDIA's chips. OpenAI recently had to raise $6.6 billion because the company is currently burning money. They're burning over $1 billion per month before accounting for CapEx. With CapEx, I don't know, but presumably they're probably spending a few $billion a month. I don't know. So the company that is currently absolutely incinerating money, losing a shit ton of money every month, and keeps doing funding rounds for relatively small amounts to keep them going, is going to buy $200 billion worth of chips from NVIDIA with the $100 billion worth of investment that they're getting from NVIDIA. You're following this? This makes complete sense. And not all of the money that they are planning to spend is coming from NVIDIA. There is...
Okay, let's pause there. He's being cynical, and understandably so, because business talk and whatnot. Um, yeah. If, well, not if, as reported, if Nvidia is investing 100 billion into OpenAI, that is money that Nvidia is capable of raising based on them committing to it, right? That's one side of the story. So if it's an investment, they're probably buying some shares. Once again, I don't know, but it's an investment or it's a loan. Either way, OpenAI receives cash. That's the main thing. OpenAI is going to receive cash, whether it's all in once or over time, they're going to receive to the value of 100 billion. And what they must do is that they need to turn 200 billion worth of product. And that's possible because OpenAI has already pre-funded its development, and this 100 billion is to have it reach the next level of development that they are targeting. And you would believe this because Nvidia wouldn't simply just give money to OpenAI if this was not the case, or if the probability of it being high. So at the end of the day, it's as simple as that, guys. If somebody says they can do something, you're gonna give them money and trust that they do exactly that. And that's basically what's happening here. Nvidia does not have to pay back the 100 billion. They just have to create the value of product worth that amount of money, or worth the amount of money that they have targeted. In this case being 200 billion. And therefore 100 plus another 100, that's 100% return. And that's that. I mean, if you looked at Nvidia, it's gotten a return of 1600 over it's the past 2 years or so. That's quite outstanding, and 100% is highly achievable. So that's really what it is. So for me, yeah, it's easy to be cynical because we want to simplify these things, but it makes sense. This is investment planning or investment management.
more. Remember, they also said that they will pay $300 billion to Oracle to use Oracle data centers. And Oracle is going to pay those hundreds of $billions to NVIDIA. And NVIDIA is going to collect those hundreds of $billions from Oracle and use that money to invest more into OpenAI. And then remember that we also have the AMD deal that just came out. OpenAI will buy $100 billion worth. It doesn't seem that you can go less than $100 billion now. That's the minimum. That's the minimum of a good AI announcement.
For those that don't know, AMD is a competitor of NVIDIA in terms of creation of chips and whatnot. So at this point, what's happening in this circular situation, it goes back to the example that I gave. There'll be three companies, and the third one has to be the, the golden goose. Now, the golden goose right now is NVIDIA. Now, when AMD is introduced, that means that NVIDIA as a golden goose has been saturated. There's too much going on. Now they need a second, third goose. So yes, there's a lot of companies involved, but for me, there's always three companies at the end of the day, or three main players. And now here you're adding another third player or another golden goose, so to speak. Golden goose is the company that creates the magic, the company that creates the most important piece of the puzzle that everybody needs. And in this whole scheme of things, the most important part of the piece is computer chips.
They're going to buy $100 billion worth of AMD graphics cards alongside the Nvidia graphics cards. But because they don't have the money to do it, AMD is giving OpenAI 10% of the total amount of AMD stock. Because then OpenAI can leverage that stock and benefit from the stock going to the moon and borrow money against it to pay for the graphics cards. You know, you're in a very special kind of bubble when the biggest companies in the space are going heavy leverage not just on their own stock, which is pretty crazy in itself, but also on the stock of other companies that they are cooperating with in the same space. And it's not just OpenAI. This is how these deals are getting done. XAI's current funding round includes $7.5 billion in equity and up to $12.5 billion in debt through a special purpose vehicle. The chips the company purchases will be leased to XAI for 5 years, allowing Wall Street financiers to recoup their investment. So instead of
So just something to expand on that. So once again, they're doing mixed financing whereby you buy equity or invest in companies and raise debt. So it can be split. But the word that I want to point out is SPV, meaning special purpose vehicle. So a lot of my mergers and acquisition lawyers will know SPVs. Once again, what's happening here is literally due to SPVs or the concept behind the SPV, meaning you create something to literally deliver a particular task or deliver a particular intention. And a lot of mergers and acquisition lawyers create such entities or such corporations in order to meet the needs of their clients. So, once again, from where we started to where we are, it's the same idea just being recycled in many different ways because different parties have different demands, and when demands come in, it changes the intention, and a means to an end is created, and at the end of the day, it's all about creating value so long as the system works. And this is how, in terms of, you hear the stock market has crashed or whatever, it's when conglomerates like this or complex systems, complex networks of such dealings collapse. That's how the markets crash. So right now everything is still in the infant stage, still early stages. So it's gonna take really a long time for this to actually fall apart. Maybe a scandal or something will sort of put the brakes on it. But in terms of the purity of AI and its potential, this is gonna really go far.
buying the graphics cards using debt, they are letting investors buy the graphics cards because that's off the books, and then lease those cards to the company for 5 years from the investors, which is probably roughly the useful life of these graphics cards anyway, running at 100% capacity for the entire duration. This is by no means a complete picture of what's been happening. There are other players like CoreWeave, a data center company that is now doing deals with both Nvidia and OpenAI for tens of billions of dollars, money moving back and forth. And there are dozens and dozens of other players in this space. You can keep writing stuff on this whiteboard forever. And the weird thing is that OpenAI's current revenue is running at around $10 billion a year. Anthropic is at about half that, on about $5 billion a year. So that's $15 billion per year from the two big ones. And the rate of growth is now slowing to below 100%. It's on course to be below 100% relatively soon. The biggest growth at the moment is coming from businesses, from companies who are paying for those commercial licenses for their developers, for staff. They're not really checking exactly how many licenses, they just like dish them out to everybody, and staff are all using AI to do whatever work they're doing. Those are just the revenues though, because remember, there are no profits, because all of these companies are losing
It's
money
just low.
on all of this revenue instead of making money. The more revenue that they take, the more money that they're going to lose. But at the same time, we are seeing these endless announcements every week about hundreds of billions of dollars moving between these companies. Dollars that don't actually exist, will not actually exist, will never exist. All of this movement is just on paper. It's Fugazi. You know that? I give you $100 billion. You give it to that guy over there. That guy is going to give it to that guy over there. That guy's going to come back and give it back to me. We've all made $100 billion. The valuations of these companies are now astronomically high because there is an expectation that in the long run, they will figure out how to make money. Maybe it will be through ads. I know you're looking forward to that, I bet. The issue is at the moment that ads enter these chatbots, you're immediately going to lose a giant chunk of the appeal, a giant chunk of trust for using LLMs in the first place. Imagine the ethical dilemma of recommending products or services or whatever for which OpenAI gets paid from the ad revenue, from the company's advertising, instead of maybe recommending other better products that do not happen to advertise on ChatGPT. At the moment, there is no business model in this space that can actually feasibly run at a profit in any short, medium term, because the physical cost of producing the answers is higher than what people are currently prepared to pay for those answers. And I just don't see a world where people are prepared to pay 10 times or 100 times what they're currently paying. Over time, this cost is not decreasing. It is.
I just want to pause it quickly. So right now, she's trying to conceptualize the demand, which is where the money is going to come in terms of how this general product or this general scheme or this complex scheme rather is expecting or betting on. Now, he's really simplifying how these guys seek to make money. Once again, there are people that they're making their money right now, and then there are people that are going to make their money way later. So some way somehow somebody is making money or realizing money right now. Now, when it comes to future earnings, revenue potential, as I said earlier, this is about being first. It's about being the yielder or the wielder of the power, meaning the power of AI. If you can become the first person to crack AI in such a way that the use case is convertible to cash, you are looking at a market domination of, let's say, 50% of the world's population, which that's about 4 billion people. Now, if you have, let's say, 50% of 8 billion people using your stuff, I mean, if you have a cell phone and at least a laptop, you are a potential client of these people. And in some cases, you don't have to use these products, the paid versions. You just have to use it. And therefore, you are a user. If you are a user, there's a potential to make revenue off you. There can be multiple ways to make revenue out of you. So, what I'm saying is the revenue potential, the revenue generation potential of these companies is truly high, and that's why the valuations are high. The difference between achieving those high numbers is they are not looking to just reach a number of revenue and that's it. They are looking to actually dominate the market, and not just dominate for a few years, but dominate it to kingdom come. So at the end of the day, that's what's creating this astronomical value popping up in terms of the companies involved. But it will slow down, and once it slows down, that means that Now investors are going to stop speculating, and now they are going to actually understand how this market works. It will fully mature, and everybody will know exactly how much money it's supposed to make. And the early adopters will cash out or remain in the system and have a very nice stake in these companies. But in most cases, what happens is the sort of like bigger players end up buying them out by trying to entice them to selling their shares. So either way, um the end of the road is lucrative. It's just a matter of we need to see how it works out.
Is increasing because of LLMs becoming more expensive to run and because users are increasing the usage per dollar that they spend, and the expectation of how much usage they get keeps going up. So tech companies have come up with this new solution. Just keep passing the money around in ever increasing amounts. First, invest 5 billion, you give me back the 5 billion. Now it's up to 100 or 200 or even 300 billion dollars per announcement. And yes, right now we're just seeing what happens. If valuations keep going up and the SEC keeps sitting around just holding their private parts in their hands, doing nothing, maybe these companies will start literally announcing trillions of dollars of investment into each other. I don't know.
Yeah, now we're going to hocus pocus territory. These people don't just do stuff. They happen because of financial models, business models that they come up with and show the actual revenue potential and profit potential that entices investors to invest. So for you to raise money is not just a matter of you just do it. And also the SEC, they will regulate and observe all of these transactions because once again, anti-competitive behavior will be the top of the list. But because this is a new industry, AI is relatively open. There's a lot of regulatory restrictions that are old, and therefore, through the development of AI, it might initially hinder, but once it overcomes, then it gets ahead of regulatory compliance or regulatory limitations, and therefore the regulator themselves needs to advance and keep up. So at the end of the day, what I'm saying is these people don't just do whatever and decide whatever. Yes, you can create a revenue model that is based on trust me, bro. But at the end of the day, these things are so complex that indeed people can make mistakes because you're over analyzing or overthinking something. But at the end of the day, it comes down to the fact that everything is done behind a promise to make money because there's a proven concept that is continuously being invested upon. But you must remember that in terms of economic principles, the higher the demand, the higher the price. So that's effectively what is happening. As I said earlier, if maybe a scandal or something creates a problem in terms of this, that's what's going to make this whole system to collapse. Other than that, yeah, it doesn't help to just be angry and wish the worst for these people or these companies because they are just printing money based on how they are colluding amongst themselves. You could hate that, it is what it is, but the truth to be told is that these companies are actually producing something that me and you can use today, and that's just what it is.
No, why not? We're only 3x from there. Today, the world has never in history seen an example of round tripping, even to a fraction of the degree that's happening right now between these companies. There is almost no precedent for things
We
like
have
companies donating
German car
10% of their own
manufacturers
publicly traded shares worth about
in
$30 billion,
Audi, VW
because
owns
they
a whole
know
lot
that
of
the
company.
moment that that happens, their share price is going to go up so much that they will immediately get tens of billions of dollars worth of more value in the business, and in the long run it'll probably be 100 billion or more because of the hype that is being generated. There are only two ways that this can unravel. Either these companies figure out a way to quickly earn about 20 times what they currently earn in revenue, and at the same time figure out how to turn a minus 130% margin into a plus 20 or 30% margin, or the house of cards will eventually come crashing down when the infinite money glitch finally runs out of infinite money. I think I am going to send out a newsletter with some more thoughts on this. If you haven't signed up, the link in the description, it's free. Go and sign up and I'll send you a newsletter. Thank you so much for watching, and I'll see you later.
All right. No, thanks for that video. Really appreciate it. Yeah, guys. I mean, yeah, that was just my thoughts reacting while watching. Tell me what you think. And yeah, look, I'm not saying he's wrong or anything. Once again, it's about perspectives. I really appreciate his insights into opening and explaining everything that's going on. It is a lot. I mean, I myself, I'm not necessarily following it the way he's following it, to the point of detailing it the way he's detailing it. But as a person that analyzes businesses and does financials for a lot of businesses, you can see what's going on. And I've just shared my perspective on that and what's going on and what happens, and just filling in those expertise from my side to a very interesting video. So yeah, go support the guy, and yeah, thanks for watching this video. Please remember to subscribe and like this video, comment, tell me what you think. Do you agree, disagree, or do you have any other thoughts? Let's talk in the comment section. All right, cheers guys.